So, in the previous class, we have calculated payback period, payback reciprocal, payback profitability for the two projects, project A and project B. And I started with the calculation of net present value for project A. The way of calculating the NPV is nothing but whatever the cash inflow we get in the later period will be discounted to bring it to the present value with the cost of capital given in the particular company. So the present value factor at the rate of 10% being for year on year is given here. We found this. Usually it may be given in your exams. If it is not so, no issue. You can find out easily. Multiply the cash inflow with the PV factor for the applicable cost of capital to find out the discounted cash inflow. It means 36,360 you have in your account today. With the 10% rate of interest, it becomes 40 by the end of first year. If you have 33,040 by today, in a matter of 2 years with the interest, it becomes 40,000 rupees. And this 27,320 rupees today, with 4 years cumulative interest, it becomes 40,000 by the end of 4th year. That's how we'll understand. The cash inflow, what you get in the future is discounted to bring the current value. Summation of these value will be the discounted cash inflow summed up value. This is what about your overall revenue you are getting. From there, your cash outflow at 0th period is subtracted to find out the net present value. As per the net present value appraisal technique, if you have NPV positive, you can choose. If the NPV being negative means the discounted value should always be higher than the amount you invest. You invest 1 lakh rupees, but you are getting 1,10,000 rupees after removing the discount component, means the interest component, by making it to present value. This 26,760 is my gain here. If you want to compare two projects, project A as well as project B, so you have to find out the NPV for the project A as well as similarly you can calculate for the project B also. Main thing that you have to note here is project A has equivalent cash inflow. Each and every year we have the cash inflow equivalently, but in case of B, we don't have equivalently. So if we have even or equal cash inflow over the period, rather than multiplying the cash inflow with a P factor for every year and getting it summed up value in the later period, simply cash inflow every year you earn is multiplied with the annuity factor. So that also you will be getting the answer directly. So this method will be applicable only when the cash inflow in the future being even, else we cannot use it. Clear? So always remember that cash inflow is multiplied with the P factor and sum up, or cash inflow is multiplied with the annuity factor where you will get the summed up value directly. So we have found out the NPV for project A in the previous class itself. So I just started with a recapping. Let me go for the second project. So in second project, okay, project B, we have cash inflow but not equal. As the cash inflow for the project B is unequal, now my duty is to find out what? Present value individually. Collectively, I cannot use the annuity factor here. So I'm going to calculate NPV for project B. Now year 1, 2, 3, 4. And cash inflow we get in project B, in this case B, very first year 60, and second year we get 70, third year 50, fourth year 50. Year on year I am getting this much amount. But all this cash inflow I am getting future. But cash outflow being today's value. So you have to bring all these cash inflows to the present value by multiplying with the applicable PE factor here. The PE factor for this company being at the rate of 10%. This value being 0.909 and here 0.826 and here it is 0.751 and here 0.683. Now multiply the cash inflow with the PE factor, you get the discounted cash inflow. Usually this value may be given in your exam, or you can calculate this way, 1 divided by 1 plus I to the power n. That formula you can use it here. Right. So for the first year 60,000 into 0.909. 54,540. For the second year 57,000 820. Third year 37,550. Fourth year 34,150. Now summation of discounted cash inflow for all the 4 years, 1,84,060. 1,84,060. Clear? From there, cash outflow at the zeroth period is subtracted. The amount you invested at the zeroth period is 1,50,000. So I am going to subtract that 1,50,000 here. So the ultimate value in this case being 34,060 NPV. If the NPV is positive, we can simply choose that. If we have two projects, the project gives you more NPV, will be most suitable one, right? Okay, clear? Now, I'll list down the NPV. Fourth one. The NPV what we have arrived for project A being 26,760. 26,760. For project B 34,060. Okay, 34,060. Selection method based on the highest one or higher one. In this case, B gives me more NPV, so we have to choose project B. That's the selection criteria for any projects using the NPV appraisal technique. Clear? Now, let's see if you compare between A and B, which gives you more revenue. A, naturally B gives you more revenue, A gives lesser revenue. But what is the investment requirement? For A, we are in need of 1 lakh rupees. For B, we are in need of 1 lakh 50. So A gives me NPV for 1 lakh rupees of investment. In case of B, we are getting the same NPV for 1.5 lakhs rupees of investment. So now my question is, in absolute sense, okay, B is good. But for relative sense means for every 1 rupee I invested, which project gives me more revenue? That question is naturally very important, right? Scoring 50 marks and 60 marks and which is better, then automatically you say 60 is better. But 50 mark is for out of 100 and 60 mark is out of 200 mark. The maximum mark may be 200. Then naturally what happens? Relatively, this is better, 50%, this is only 30%. For every 1 rupee, how much you are earning will be more logical way of decision making also. For every 1 rupee invested, you need to get good money, not the absolute sense. If you say that I get 10,000 rupees for 1 lakh rupees investment, another fellow says I get 20,000 rupees investment for 1 crore rupees of investment, 20,000 profit for 1 crore investment. So logically not acceptable. So in order to understand the relative sense, we need to go for the next appraisal technique. That next appraisal technique is all about profitability index. Profitability index or benefit cost ratio or desirability factor. You can use the other name also for the same, PI ratio or BCR ratio, BCR, benefit cost ratio or cost to benefit ratio, or desirability factor. So any name you can use it. So predominantly we use profitability index, PI in short. In case of project A, PI is equal to NPV by cash outflow. NPV by cash outflow. You are getting 26,760 for your investment of rupees 1 lakh. So how much you are getting? 0.2676 or 26.76%. Both the way you can answer. Both the way you can answer. One more method we have. Okay, one more method. Rather than NPV, sometimes we take summation of discounted cash inflow by cash outflow. That method also you can consider. If you go for this one, 1,26,760 is your overall cash outflow, and overall discounted cash inflow for overall cash inflow outflow of 1 lakh rupees. So you have invested 1 lakh rupees, but you got around 1,26,760. Naturally, you get 126.76 percentage or 1.2676. Remember, when I use the second model, the PA will always be greater than 1. Then only it is acceptable. In case of NPV model based PA, it should be always positive, not being that negative. Is that okay? This 1, that extra 1 between these two, right? So the difference between these two, 1 represents the investment, this component, this 1 lakh component. Is that clear? So 1.2676 minus 2676, that difference 1 represents the means in investment. So this is 1.2676. This is 1. This is 0.2676. That's the logic behind. So you can represent the NPV, sorry, PA under this model or under this model. Both are accepted. Both are accepted. So here the answer being, in case of PA, profitability index. In this case, 0.2676. In this case, I have to calculate for B. Let's go for B. In case of project B, okay. So the same way, PI is equal to NPV divided by cash outflow. So NPV being 34,060 divided by cash outflow, in this case being 1,50,000. Then what's the ultimate here value here? 0.227. Other way, summation of discounted cash inflow divided by NPV cash outflow. Naturally, what happens here? You will get 1 excess. Okay, 1.227. The difference between these two models, one number is extra. So 0.227. 0.227. And decision criteria or selection criteria, higher number will be the most attractive one. In this comparison, A gives me more revenue. So you get now confused. Under the NPV model, you're supposed to choose B. If I use the PA appraisal technique, you choose A. Then I have the confusion, which among the two better for me? So that question naturally comes, right? So when that question comes, always remember, do you have sufficient cash balance in your hand? Okay, A requires 1 lakh, B requires 1.5 lakhs. You have 3 lakhs in your bureau, ideally available. You don't have any other option. So then, if you invest in A, you will be getting around 26,760 NPV. Same if you are investing in B, 34,060. In case of investing in A, you have 3 lakhs rupees, 1 lakh invested, remaining 2 lakhs is in your bureau itself. In case of B, you have invested 1.5 lakhs, 1.5 lakhs in the bureau. The amount available in the bureau remains idle, means excess cash you have. Sir, I don't have any cash, sir. I have limited resources. I need to borrow and invest. Okay. In that case, you have to be double cautious. For every penny you invest should give you more revenue. So from this, it's very clear. Do you have sufficient cash balance or not? If you have sufficient balance, decide based on NPV. If you have the limited resources, decide based on PA, profitability index. Okay. Actually, we'll study in subsequent lectures all about probably limited resources. You have so much money, how can we? Okay, how can we handle the problem? Okay, capital rationing. That problem is called capital rationing. So ration, you know that, right? Limited supply. Okay, so at the rate of in the public supply service domestic products, you are purchasing wheat and all. Okay, at less rate in the rations. So it's for the people who are not rich enough to borrow from, purchase from the department stores, where it is now given certain limit only, rationing, not beyond that. Okay, because all the people should enjoy the discounted price. That's why it is called rationing. Okay, ration. Capital rationing means my capital is limited, sir. How can I plan, sir? Go for the PA model. You can plan PA model. Capital rationing. Clear? Capital rationing. Now, I'll move on to the next model. So we have completed PB, payback period, payback reciprocal, payback profitability. We have completed NPV as well as PA. Now we'll be moving on to the next model. Okay. So next model. I'm going to deal with discounted payback period. Discounted payback period. So the main drawback of payback period is we never bother about the time value of money. We never bother about the time value of money. Whatever the cash I have, no problem. Whatever the cash I have, no problem. Okay. If I get to 1 lakh rupees 5 years later, you never bother. I'm getting no. That's what about the time value of money not considered. But tomorrow's money is not equal to today's worth. So you have to what you have to do. You have to adjust the time value of money. That drawback is now resorted here. We have to discount the future cash inflows using the cost of overall capital. That discounted value should be sufficient enough for your initial investment. Whatever the initial investment you have done, you have to recover it over the period of 4 or 5 years. Okay, within how many years I will get it back. So let's see. In case of project A, year, so year, what about the 10% PE factor here? 0.909, 0.909, 0.826, 0.751, 0.683. Okay, 683. Now for project A, cash inflow and discounted cash inflow. Okay, cash inflow for A being 40, 40, 40, 40. In case of non-discounted simple payback period, I get 1 lakh rupees by the end of second 2.5 years. In the very first year, I get 40. Second year, I got another 40. Third year, it goes beyond my investment. So anywhere between 2 to 3, I'm getting the money back. In 2.5 years itself, I'm getting money back. But all the cash I get in the future is not today's worth, today's equivalent value. So I'm going to discount it. So I'm going to discount it using 10% rate. So 40,000 into 0.909, this value being 36,360, 33,040, then 30,040, finally 320, 27,320. We got the cash inflow. If you compare the cash inflow and outflow using cash inflow, that's a simple payback period. If I'm comparing the discounted cash inflow with outflow, then it is called discounted payback period. So when I'm getting, first year I get around 36,360, second year if I add 33, almost I'm getting 69,000 something. Okay, still there is a shortage of my investment. Another year, another 30,000 rupees. Okay, so you can better calculate one more item called cumulative discounted cash inflow. Up to first year end, I get 36,360. So all these things are for project A. So next year I get 69,400, 99,440. Still there is a shortage. The last year I am getting 27,325. Add how much I am getting? 1,26,760. Clear? Hope now you'll be able to understand this one. Now, payback period should be anywhere between 3 and 4. Third year, small amount shortage is there. 1 lakh I have invested, 99,440 got, so 560 rupees shortage is there. In the next year I get more than what I have invested. So definitely my payback period, discounted payback period should be anywhere between 3 and 4. Okay, between this one here. Okay. So by the end of third year, I get so much money. So 3 plus there is a shortage. How much a shortage money is there? 560. And how much I earn in the next year? 27,320. This is how you can calculate the discounted payback period. 3 plus 560 divided with 27,320. Then what is the ultimate value? 3.02 years. You will get your investment back by the end of 3.02 years. Without discounting, we get by 2.5 years, but now it takes another half year extra for recovery of that interest component. Clear? Hope now you'll be able to understand project A, calculation for project A. Let's now move on to the project B. You repeat the same process for the project B also, no problem here. Let's see. Cash inflow for project B, this much for every year, 60 in the very first year, 70 in the next year, 50 in the third year, another 50 in the fourth year. So 4 years. I need to find out discounted cash inflow. Okay. So very first year, 60 into 0.909, how much is the answer? 54,540. Okay. Okay, this one already we have. Okay. Now second year 57,820. Third year 37,550. Fourth year 34,150. Better find out the cumulative discounted cash inflow. Yes, very first year I am getting 54,540. Second year how much I am getting? 1 lakh. 1 second. 1,12,360. 1 second, 1 second. 1,12,360. Then 1,49,910. Then 1,84,060. So how much I need to get? 1,50,000 rupees. This is for project B. So 1,50,000 I am getting anywhere between 3 and 4 years. Okay, I start with third year, discounted payback period, plus the shortage here. I need to get 1,50,000, but I got 1,49,910. 90 rupees shortage is there. And in the next year, how much I am getting? 34,150. Then ultimate value here being how much? 3 years, almost small fraction. So 3 years, small fraction, 3 years. 3.02 for project A, 3 years is for project B. This is all about discounted payback period. Discounted payback period. In the very first case, 3.02 years, and here 3 years. Selection criteria is nothing but the highest of these values. If we have 2 projects, only higher of these 2. If we have 10 projects, do the same way and find out the highest among the 10, and that will be chosen here. So here we can choose, shortest. Okay, here, shortest. Okay. So definitely we can choose B here. If you are getting your money back quickly, then you can choose it. So we have chosen B project here. Clear? Yes. Hope now you'll be able to understand the payback period. That to discounted payback period. Only one method to go, internal rate of return. So almost we have completed 6 appraisal techniques. Okay. Now I'll move on to the last one, internal rate of return. Internal rate of return. So company's cost of capital is 10%, right? Internal rate of return, or in short, I call this being IRR. I call this being IRR, internal rate of return. Internal rate of return is nothing but if you are discounting these value with some rate. Okay. Anyhow, today whatever the rupee you have, in future it will grow. Today if I have 100, together with the 10% return, it becomes 110 by the end of first year. That's a logic. 100 becomes 110. If you want to make 100 rupees to 115, the rate of interest should be 15%. Am I right? 100 becomes, by adding 10 rupees, 110. To make it 115, what could be the interest should be included here? 15 rupees. Very simple, right? So together with the 15% rate of interest, that 100 becomes 115. Clear? Now my question is, today's value is 100, tomorrow's value is 115. What could be the hidden rate of interest? What could be the hidden rate of interest? Naturally, 15%. That 15% hidden rate of interest you calculate now, 15%, that is called IRR here. If I tell you, I invested 100 rupees, by the end of first year, I am getting 120 rupees. I invested 100 rupees, by the end of 1 year, I get 120 rupees. What is my return? Naturally, 20 rupees for my 100 rupees of investment, 20%. This 20 rupees is called IRR. If I ask you, 100 rupees I invested at the 0th period, it becomes 120 by the end of second year. What is the hidden rate of interest rate? Now there's a problem. We cannot say 20 rupees is the overall growth for 100 rupees. 20% change happens, okay. This is over the 2 years period. Why? But my question is, what is the interest I'm getting every year? You understand? What could be the hidden rate of interest here for every year? 1 year, no problem. 100 becomes 150 in a matter of 1 year. Then 50% is the rate of interest. 100 becomes 200, then 100% is the rate of interest or rate of return. But I invested 100, it becomes 200 by the end of 5th year. Then I'm not sure. Then how can we calculate the rate of interest? We have to assume some rates ourselves, trial and error. Trial and error. Using the trial and error only we can calculate. So for example, 100 becomes 120 by the end of 2 years means what could be the rate of interest? Naturally, 20 rupees for 2 years means roughly 10 rupees per year. But that 10 rupees interest also gives interest for the second year, cumulative. So the required rate of interest should be less than 10%. So now you assume some rate like 8%, 9%, 10% like. For example, 100 rupees, if I assume 8% rate of interest being the answer, I'm not sure, it's called trial and error method. I assume that the rate of interest I'm getting every year in being 8%, the first year interest for the first year being 8 rupees, then this money grows up to 108 by the end of first year. 0th value 100, it becomes 108 by the end of first year. And interest for the second year, again I am getting 8% on this 108. Come on, tell me. 8.64, then 116.64. But I told you it becomes 200. Naturally, what happens? This is mismatching. Definitely, this is not the answer. This is not the answer because 3.36 value is there. 100 rupees investment became 116.64. Sorry. It become 120 by the end of second year. So 3.36 is the difference. So definitely 8% is not the answer. What can we do? Go for 9%. If we go for the 9%, 100 rupees I have invested will fetch me 9 rupees interest by the end of first year. Then it becomes 109 next year for this 9.81. So overall value being 118.81. Again not matching. 100 rupees investment. I say I invested 100 rupees by the end of second year, it became 120. Then if I ask you what could be the rate of interest I gained in this, definitely you have to go for trial and error method. So I get 120. So naturally what happens here? Naturally what happens? I am getting 1.19 short than the actual one. So this is not the answer. Now I have to go for one more rate, probably 10%. So if I go for 10% rate, I invested 100 rupees very first year, 10 rupees I get the interest, so 110. Next year for this 110, 10% interest, 11 rupees I may get, so 121. But my return is 120. So there is a shortage 1 rupee. So 8% is not the answer, 9% is also not answer, 10% is also not answer. So I have to find out now what could be the exact value. Then there is a confusion, trial and error method. If you are raising the value rate from 8, 9, 10, like the value will be gradually increasing closer to the investment. But when it is 10, the money what I get by calculating using 10% is higher than the return I am getting. This may be NPV like. This is what about the summation of discounted cash inflow like. That's how you can assume. And this is the outflow like. Now, 8% is not the answer, 9% is not the answer, 10% is not the answer, then what could be the exact answer? Then it should be anywhere between 9 and 10. Can I take 9.5%, 9.4%, 9.2%? You can do all these things in your own home. Okay. So I tried in my days. I did lots of trial and error method. I started with 9.5%, 9.4%, 9.3% and all. Similarly, you can do, but there is a shortcut. Interpolation. Interpolation says this is the method. What? At 9%, you are getting 118.81. At 10%, you are getting 121. Okay. So for making a change of 1%, how much change happens here? 2.19, am I right? For making 1% change from 9 to 10, the value increases from 118.81 to 121. But from 9% to, I have to increase such a number to make it equivalent to 120. 120. What is the shortage amount here? 1.19. For 1% change, you understand? My requirement is 120, right? 9% 118, 10% 121. I don't want these two. I need 120. Then that 120 should be anywhere between 9 and 10. So from 9, I have to still increase how much? 119. But if the rate is increased from 9 to 10, the change being 2.19. But my required change is only 1.19. This is my required change. Do the cross multiplication. Start with a lower number, add this particular value here. What is that? 1.19 divided by 2.19 into 100. What's the value? Into rate of interest. Okay. Cumulative means the class interval. Come on, tell me. This is called class interval. The difference between the rate. Come on. 9.54 is the answer. Let's try this one. If the rate being 9.543, what could be the value? If I invest 100 rupees today, by the end of first year, I get 9.543. And by the end of first year, I'll get 109.543. Then you have to add interest for this at the same rate, 109.543 into 9.543. What is the value? 10.454. Okay. 4 like, if you add up this, then the ultimate value being 120. Clear? It's now matching. So we found that the value being 9.543 is the correct answer. So for finding the rate of return I am getting in this particular cash flow stream, 100 rupees invested today, 120 later on by the end of second year, what could be the hidden rate of interest rate? In simple, 1 year means you can calculate easily. In case of 2 years or 3 years, okay, roughly you can guess. How can you guess roughly? How can you guess the value roughly? It's very simple. 20 rupees for the 2 years means per year 10 rupees for your 100 rupees investment means 10%. It should be closer to 100. Maybe because of the cumulative effect, there will be slight change. You can guess it easily. You can guess it easily. Is that clear? Clear? Now for A, I'm going to calculate what is the rate of interest. That rate of interest is called internal. So I have just given the concept here. No need to mug up this. I'm going to solve the illustration now. A and B. Let me solve the project B first and then go for project A. Let's see. In case of project B. I get so much money, 60, 70, 50 over 4 years period for my 0th period investment being 1,50,000. Then what could be the hidden rate of interest? We assume ourselves some rates. Definitely 10% is not the answer. How? We already calculated when we use the 10% rate. Okay, in case of project B, you have surplus. 34,000 surplus. Definitely 10% is not the answer. We have to now guess some answer. Is that clear? Now, we'll start with around 18%, 20% like, okay. For project B, I may choose around 20% here directly. Okay. How will you get 20% directly, sir? I know the answer already. Yes, you have to do lots of trial and error. What happens in our examination, sir? They may give the annuity factor and PE factor, no? They will give only 4 or 5 PE factor set for 18%, 20, 22, like they will give only 4 or 5 sets. So from that, it's very clear the answer should be anywhere from there. So that's how you can guess in your examination, no need to worry about that. So here I knew the answer, so I'll start with 20%. Okay, not necessary, but in your practicing period at your own home, you can guess yourself. You'll get lots of interesting values also. So for example, I will do this way also, rough guessing. Okay, rough guessing. 60, 70, 50, 50. What's the value overall? 1 lakh, 2 lakhs 30. Am I right? 2 lakhs 30 for 4 years per year, roughly 65. 65 per year roughly means for 150 rupees of investment, how much you are getting? 43. But because of the cumulative effect, definitely it should not be 43, it should be less than 43, maybe 30, 25%. That's how you can guess where the number could be. If you are practicing that in your home. Clear? But anyhow, in this case, see, once in an examination, they have asked this way. Find the missing value considering the following table of PV factor. That's how examination question contains. You have been given discounting factor for 15, 14, 13, 12. So from this, it's very clear the IRR could be any one of these values or among these values between. Okay, that's how you can guess. So don't panic. So how can I guess and get our answer? No need to worry about that. In practical life, you can use the Excel sheets. It will calculate and tell you. In case of practicing at your own home, so you guess some way to get the answer. And in case of examination, that method is given. That 4 or 5 factors may be given. The required IRR should be anywhere between these values only. Clear? So I'll start with 20% here. Internal rate of return, that too for project B. Clear? In case of project B, year 1, 2, 3, 4, cash inflow. First year 60, second year 70, third year 50, and fourth year 50. Now I'll take 20% PE factor here. Yeah, come on, get me the 20% PE factor. How can you get in your non-scientific calculator? 1 divided by 1 plus I being 0 0.2. 0 0.2 is the answer. Okay. So in your non-scientific calculator, you can do this way. 1 divided by 1.2 equal 0.833. Then again press equal. This is the second P factor, third P factor, fourth P factor. That's how you will get the answer easily. So first year it is 0.8333. Second year is 0.694. Third year 0.578. Fourth year 482. Now find out the discounted cash inflow. You multiply these two and get me the value. Okay, 49,000. 60 into 833. 50,000, right? 50,000, we can round off, right? 14 something, so the value being 50,000. Next to 48, 611. Don't panic with the rounding of error. It will have the error of so around 2 digits also sometimes. Don't panic. Then 28,000, 935. The last one 24,113. The total value being 1,51,659. This is what about the summation of discounted cash inflow. So IRR represents that summation of discounted cash inflow should be equivalent to cash outflow. If you are using a rate, that rate equivalent to these two, or makes the summation of discounted cash inflow equivalent to the cash outflow, no, that value is called IRR. This is called IRR. So definitely this is not the correct answer, because my project investment is 1,50,000, but I'm getting more than 1,50,000. So that 1,50,000 is my outflow, cash outflow. Then difference between these two, 1,659 excess we have. Maybe NPV at this value. Is that clear? Clear? Now, my intention is match these two. This is what about my requirement. Summation of discounted cash inflow should be equal to cash outflow. To match these two, currently the summation of discounted cash inflow at the rate of 20% is higher than the cash outflow, so not matching. This is not correct. Now the summation of discounted cash inflow, what we have to do? Bring it to 150, means you have to reduce. In order to reduce the summation of discounted cash inflow, the required rate of interest is higher or lower than the existing one? Come on, more than 20 or less than 20? Come on, tell me. Definitely 20% is not the answer. Do I want to go for 21% or 19% for making it equal? Come on, tell me. Less than 20 or more than 20? What does it mean? 20% means discounting factor. Means you are discounting the value at the rate of 20. You are discounting with the 20% to arrive 151. You have to further discount back. Means you have to raise the value to 22%, 21%. Like, you understand? So, if you are increasing the discounting factor, the value will be discounted more. Okay, to reduce this summation of discounted cash inflow equivalent to the cash outflow, I have to increase the discount factor. So, I may go for 22%. So, 22% P factor. Okay. In case of 22% P factor, the value being, you can use the same, like, okay, 1 divided by 1.22. Okay, 0.820, 8196 can be rounded up to 82, and 672, like this you can calculate. In the very first year, 0.820, second year 0.672, third year 0.551, Here 0.451. Now find out the discounted cash inflow at this rate. You multiply the cash inflow with the 22% PE factor to get the discounted cash inflow at the rate of 22%. 49,180, 47,030, 27,535, and 22,570. Overall value being 1,46,316. Now what happened? The value is now negative. NPV being negative, 3,684 negative. So 20% there is excess amount. In case of 22%, there is a shortage in amount. So definitely the required answer should be anywhere between 20 and 22. So then you can use the interpolation. Under interpolation, at the rate of 20%, you have how much? 1,51,659. At the rate of 22%, this value becomes 1,46,316. This is rate of interest. This is summation of discounted cash inflow. Okay. I made a change of 2%. That leads to a change of how much? The difference between these two? Huh? 5,343 is the difference. But what is my requirement? I have to reduce it to 1,50,000 only. For 2% change, there is a discount valued by 5,343, but I don't want to discount so much. I need to discount only 1,659, the difference between these two. This one should be discounted. I have to discount only this much. So 1,659. So from this it's very clear. 2% change discounts the value by 5,000 something. But I need to discount only 1,600. Then what would be the change in interest rate? You can do the cross multiplication to find out the rate of interest to be changed. Always you start with the lower number, 20%, and find out this value and add here. Okay, find out this value, this question mark, and add here. Okay. How? 1,659 into 2 divided by 5,343. Then what is the ultimate value? 20.62 or 58? 58. Okay. Rounding of error will be there. No need to worry about this. 20.58 will be the answer. Is that clear? 20.58 will be the answer. Can you rework out using that rate? Yeah, of course. Go home and try. Find out the P factor at the rate of 20.58 and discount it and find out the value, whether it's matching or not. You can try it at your own home. Right, no problem. But will it match? Definitely will not match. Small 100 rupees difference will be there. That's a rounding of error. Now see the gap. See the gap here. What is the gap between these two? 2%. Sir, can I calculate for 10% and 100% and interpolate? 10% and 100%. If the gap is higher, accuracy is missing. If the gap is very closer, you will get more accurate. 2% reasonable, 3% reasonable. Don't go beyond that value. So the accuracy may be missing. Let's see, even here we have 2%, no, maybe slightly less accurate. If you have just a half percentage or quarter percentage variation, it will be more accurate. Let's try. Yeah, of course, it's not required for your exams. You can finish up with this, but for our further learning, we can use this rate to check whether we are getting the answer or not. Come on, tell me. What is the PV factor at this rate? 20.58 PV factor. Of course, not required for the examination. It's only for the further learning. 1 divided by 1.2058. Okay. How will you get? This will be 1 divided by 1.2058, 1 plus I. Okay, so that's how you can get it here. 1 divided by 1.2058. Okay, this is how we can get the value being 0.829, 0.688, 0.570, 0.473. Now find out the discounted value here. Discount this by multiplying with this 60,000 into this value 0.829. What's the value? 49,740. This is what about the discounted cash inflow, where the applicable discount rate is 20.587. The next one being 40, 48, 160. What is the next one? 28,500. The last one? 23,650. Get me the total of this. Yeah, tell me. 1 lakh? 1,55,000. 50,000. Okay, 1,50,000. 50. Wait. This answer is wrong. 49,000. What is that value? Come on. 60,000 into. Okay. 49,740. Am I right? 49,000. Okay. 1,50,000. 50 rupees. There's a 50 rupees difference. Okay. So 50 rupees difference. Then you can calculate further. That's up to you. Okay. Rather than 2% difference, if it is 1% difference, more accurate will be there. Okay. If the difference between these two and the class interval 20 to 22 rather than 20 to 22, if you take 20% to 25%, the accuracy is missing. Clear? Now, let's see. We'll move on to the next one. Clear? Have you copied this? Now listen. Now listen. In case of project A, I'm going to calculate the internal rate of return. Summation of discounted cash inflow should be equal to cash outflow, where this is discounted with some rate, that rate is called IRR. What happens if the cash inflow is uneven? Then this can be calculated using cash inflow for every period into PV factor and do the summation. But if the cash inflow being even, you can simply calculate this way, right? That's all. That's why I'm going to calculate the A now. I'm not going to calculate for each and every item to be discounted. I'm going to use the annuity factor here directly. So here the formula being very simple, like it should be equal. Okay. Now I may consider again 20 percentage, like, okay. In case of this one, I think I'll start with 20% as usual. 20 percentage and 22 percentage. I'll use the same one here also. If I choose the IRR being 20 percentage, IRR being 20 percentage. Clear? Now let's see. How do I calculate? Cash inflow is multiplied with the annuity factor, should be verified with the cash outflow and find out whether it is equal or not. If 20 percentage means the cash inflow being 40,000 every year, multiplied with the annuity factor for 20 percentage. Okay, how do I calculate? The P factor, what we calculate for 20 percentage year on year for 4 years, make the summation of those things. So then the answer being 1, 2, 3, 4. The grand total being 2.5887. 2.5887. You can of course round up to the nearest 3 digits also. No issues. But I'll go with full 4 digits here. Minus 1 lakh. Should be equal to 1 lakh. Or you can subtract 1 lakh. It should be 0. Is it 0? Definitely it is not 0, right? So you get 3,548. 3,548. You have excess value. So definitely 20% is not the answer. This value being 1,03,548. Outflow being 1 lakh. So not matching. Otherwise the discounted value is higher by 3,548. Now this value should be reduced. To reduce, what we have to do? Increase the rate of interest. So the rate of interest is increased from 20% to 22%. 22%. So 40,000 into, find out the annuity factor at the rate of 22%. So 1 divided by 1.22. Okay, you can do the calculation for the 4 years and take the grand total of this. The grand total of this being 2.4936. 2.4936 minus 1 lakh. Okay. 2.4936 into 40,000. Okay. Minus 1 lakh. So you get now negative value. 256 negative. Okay. Otherwise, this value being 1,03,548. This value being 99,744. 20% we have the excess value. At the rate of 22%, the value will be in shortage. So for 20%, summation of discounted cash inflow being 1,03,548. For 22%, this value being 99,744. So 2% you increased because of this change. Okay. There's a change by 3,804. 3,804. My requirement is to make it 1 lakh. I'll take this 20% as the base. When the rate of interest is 20%, this is excess by how much? 3,548. By making a change from 20 to 22, there's a change by 3,804, but I don't want that much. I want only this much, 3,548. Now do the cross multiplication to get it and start with the lower number, add this number. 3548 into 2 divided by 3804. Okay, 3548 divided by 3804 into 2. This value being 1.86. With that, if I add 20, 21.87 percentage. 865, otherwise 87 percentage. Clear? Now, the IRR for A, last one, seventh one, IRR for A, 21.87 percentage. IRR for B, how much? 20.58. Okay, 20.58. How can you choose higher IRR? If two projects are there, then higher will be taken. If we have only one project, IRR should always be greater than your cost, KO. Okay, clear? IRR should be higher than the cost of capital. Company borrows the fund at the rate of 10%. Company earns 15% because of the IRR. Then they can go. The IRR is only 5%. What does it mean? This company gives you gain only 5%, but this company borrows 10% rate, so definitely it's a loss. So we can choose between these two. A. A is chosen here. Clear? So you have to understand all the model. Not only that, understand how to make the decision from the answer. If there is only one project criteria or more than one project criteria. In case of one project criteria, in case of payback period, company will have some norms. Whatever the amount we invest, we have to get it back within 3 years. That's how the company may have the norms. If the payback period within the norms, then they will go for the investing, else they cancel. In case of 2 or 3 payback periods are there, 2 or 3 projects are there, lower of this value can be taken. Okay. Similarly, in the case of IRR, only one project is there. That IRR should be higher than the KO, else we reject. Okay. In case of 2 or 3 projects are there, higher IRR will be chosen. In case of NPV, higher number will be taken. If we have only one project, then positive will be chosen, negative will be rejected. Okay. So here the company norms will be accepted. And in case of NPV, positive is chosen, negative is rejected. In case of PI, naturally positive and negative. Okay, positive will be chosen, negative is subtracted, means removed. In case if you take the other way, this way, 1.2676 model, you have no other way. Okay, if you are subtracting the cash outflow, you will get the value usually in fractions. If you are taking the entire cash inflow, okay, summation of discounted cash inflow, the value should be higher than the one. Higher than 1 will be chosen. Okay, in this case. And in case of IRR, it should be higher than the KO. Higher than the KO. So decision criteria is most important here. Clear? Now, in your text, I have given NPV, positive or highest will be chosen. Profitability index, highest will be chosen. And IRR, that IRR should be higher than the KO will be chosen. The decision criteria also I have given. Clear? Yes. Make a note of it. If it is over, text me. We will move on to the next concept. So we'll now move on to the next concept called average rate of return. Calculate average rate of return, or sometimes it may be named as accounting rate of return. In this model, we consider the profit and time value of money is not acceptable or considered here. These 2 points. Rest of the other models we have seen, in capital appraisal technique, we have the cash flows. Here we don't have the cash flows, we have the net profit. So you have to understand the difference between net profit and cash flow. In the subsequent lectures, I will guide you how to calculate the net profit, or if the net profit is given, how can we calculate the cash flow. So the both the way you have to understand to calculate. In the case of advanced illustration, they don't give the cash inflow. They may give the net profit. To find out the cash inflow, you have to do one some other working notes also. Okay. And tax impact, time value of money, all these things are going to be incorporated to make it advanced illustration. Now, average rate of return is nothing but net profit ratios. Like, what about the amount you have invested, for that how much you are getting? That can be represented as rate of interest, rate of return. That's what about accounting rate of return or average rate of return. Right. Now, see here. ARR is equal to ARR is equal to ARR is equal to average PAT. Average PAT or EAT represents earnings after tax, net profit in general, divided by average investment. Average investment. That's all. Okay. Now, average EAT is nothing but average EAT is nothing but EAT of various years divided by N. Summation of EAT divided by N, number of years. Here you see, calculate average rate of return from the following information, where the cash outflow being 100, you have invested so much money. You are getting earnings after tax for the 5 years so much money. To take the average of this, 20 plus 22 plus 24 plus 26 plus 28 divided by 5. So the answer being 24. Okay, if it has a progressive value, then mid of the value will be the average, usually 24. Then average investment, okay, in case of average investment. Okay, opening investment minus closing investment or scrap value. Scrap value will be the closing investment. You purchased an asset for 1 lakh. By the end of 5th year, the value of the asset being 20 lakhs, scrap value. Okay, so 1 lakh and 20. The difference between these two, the average investment over the period. And add the working capital requirement if you are investing anything. Add the scrap value back. This is the formula for this. I will explain how this formula is arranged. First, we'll understand in simple sense, then let me explain you the formula derivations also, how this formula comes here. Right. So the opening investment being 100, scrap value at the end of, also find out the ARR in the following cases. Case 1 is this one. I'm going to follow, I'm going to find out the answer for the case 1. Also find out the ARR in the following cases. Scrap value at the end of the year being 20. So opening investment 100, scrap value 20, number of years in this case being 5, and plus working capital requirement is not given, and scrap value given being 20. What is the ultimate value? This is 16 plus 20, 36, am I right? 36. Divided by 2, average. Not here it is 5, okay, but here it is 2, okay. Then what is the value? 40 plus 20, 60 is the answer. 60 is the answer. Here 5 is okay, but here only 2. It's not the life. Average EAT in this case being 24 and divided by 60, and come on, tell me the value finally. 40 percentage. 40 percentage. In the second case, scrap value is 20, but we have working capital requirement also 20. So definitely in this case, average it being the same 24, but what will be having changes? Average investment will have changes. Opening investment 100 minus closing investment 20 divided by 2. Don't forget to add the working capital requirement, which is 10, and add the scrap value recovered 20. Then what's the value here? The final value being 70. Now here it is 70 in percentage. The final answer being 34.29 percentage. Is that clear? Clear? So in average rate of return or accounting rate of return, we take the EAT, average EAT divided by average investment. Average EAT by average investment. The formula being average EAT is very simple, summation of all the EATs divided by number of years. And in case of average investment, opening minus closing divided by 2 plus scrap value plus working capital will be the formula. Then how the formula comes here? You have to understand the logics behind, right? So let's see. Let's see. If it is clear, text me. We'll go for the formula derivations also. The understanding the formula, not derivation, understanding. See here. Let me explain here. Now, what about the depreciation? Original value minus scrap value divided by life. 100 rupees you invested, scrap value being 20, divided by life being 5 years. 16 rupees is the depreciation. 16 rupees is the depreciation. So you have invested 100 rupees. Depreciation for the first year 16, then it becomes 84. Depreciation for the second year, this is original value, this is WD value. Second year 16, if I subtract, then the value being 68. Again, depreciation for the third year 16 is subtracted, so 52. Depreciation for the fourth year 16 is subtracted. What is the final value? 36. And depreciation for the fifth year 16 is subtracted, so you will get scrap value by the end of fifth year. Okay, by the end of fifth year. Isn't it? That you know. In case of first, scrap value at the end of the year. Year beginning, you have 100 rupees as your asset. Year end, you have 84 as asset. This is opening value in year 1. This is closing value of your asset in your balance sheet by the year end. Second year, you started with 84, ended with 68. Third year, the net assets in your balance sheet being 68. In the year end, after the depreciation, it becomes 52. And fourth year, in the year beginning, 52, and year end, it becomes 36. And fifth year, we started with 36 and ended with 20. We ended with 20. Now, what about the average for every year? First year average being 92. Second year average being 76. Third year 60. Fourth year 44. Then 28. You add 8 with the closing or subtract 8 from the opening. That's all. You will get the average. Don't always fight with the calculators, right? So, with that you add 8. That half of this. Very simple. Clear? Now, get me the total of this. Get me the total of this. 260 for how many years? 260 or 300? 300. Be careful. 300. Clear? For how many years? 5 years. Then what about the final value? 60 is the average cap. We got this one directly here. Clear? So this is nothing but opening investment minus scrap value by 2. Finally add the scrap value. What about the working capital, sir? Working capital, there is no depreciation, right? If you want to start the business, you will start with some stocks, some debtors. You have 100 rupees worth of stock in your business. Year beginning 100, year end 100, year second year beginning 100, and the last year the working capital remains 100, and you sell off the entire stock by the year end. So the 100 remains constant. So if there is any working capital requirement, the working capital in this case being 10 remains constant for all the period. Okay. Opening also same, closing also same. So average is also same. Then automatically take the average of this, then you will get the 10. So with the working capital, the average capital be 70. Hope you will be now able to understand. Without working capital, the average is 60. With the working capital, the average is 70, which is nothing but the average capital employed for the year beginning, year end divided by 2. Okay, that's how we'll do. Rather than calculating year on year, we can simply use this formula: opening investment minus closing investment, which is nothing but scrap value with the end of the nth period divided by 2. We will get the average of this amount used. With that, you don't forget to add the scrap value and add working capital if any. Is that okay? Hope you will be now able to understand the average rate of return concept. Come on, make a note of it. So you can try yourself, and if you have doubt, you can watch this video. Question number 3. A company has to make a choice between two projects, namely A and B. The initial capital outlay of two projects is 1,35,000 and 2,40,000 respectively for A and B. There will be no scrap value at the end of the life. Opportunity cost of capital of the company is 16%. The annual income or as entered. So we have two projects, project A and project B, and P factor is also there. And investment details are also available. We have to find out the discounted payback period, profitability index, and net present value and all. Let me first finish up calculating the NPV. So for the NPV, how can we calculate? It's very simple. Summation of discounted cash inflow. From there, cash outflow is calculated. Then you'll get the NPV. In case of profitability index, the formula is very simple. Summation of discounted cash inflow divided by cash outflow. That's how you can do it. So we'll try to finish up these two, because for these two, we are in need of summation of discounted cash inflow. To find out the summation of discounted cash inflow, let me first finish off calculating discounted cash inflow. Okay. For project A, discounted cash inflow is nothing but cash inflow is multiplied with the PV factor. Okay. Now year 1 0, P factor is this one, so 0. Second year 30,000 into 0.743. 0.743. If I multiply these two, the answer being 22,290. Then 1,32,000 into 0.641, the answer being 84,612. Next one is 84,000 into 0.582, the answer being 46,368. The last one, 84,000 into 0.476, this answer being 39,984. The overall value being 1,93,254. This is nothing but summation of discounted cash inflow. So we got this value. From there, cash outflow of this project, project A, 1,35,000 is subtracted. Cash outflow, 1,35,000 is subtracted. Then ultimate value will be my NPV here. The NPV in this case being 58,254. Okay. This is all about project A. Project A. And to find out the PI, for PI the formula being summation of discounted cash inflow divided by cash outflow. Okay, so this one 1,93,000 here these two 1,93,254 divided by 1,35,000, the answer being 1.43. For project B, the same way, first let me finish up calculating the discounted cash inflow. Cash inflow is multiplied with the P factor here, 60,000 into 0.862, this value being 51,720. Next to 84,000 into 0.743, this value being 62,412. Then 96,000 into this value, 61,536. Next one, 1,02,000 into 5.552, the value being 56,304. The last 90,000 into this one, this value being 42,840. Then overall total being 2,74,812. My outflow in this case being 2,40,000. Then NPV in this case being 34,812. PA, the relationship between these two numbers, summation of discounted cash inflow divided by cash outflow, this value being 1.15. So we have calculated the NPV as well as PI for both the projects. Okay, based on the NPV, we can choose project A as it gives me more revenue. Based on PI, we have to choose A as it gives me more PI. In both the cases, we have to choose A. Apart from that, we have to find out discounted payback period. Payback period discounted. In case of a discounted payback period, you have to find out cumulative discounted cash inflow first of all, and you have to find out that cumulative cash inflow should be equivalent or more than the amount of investment. So first year we don't have any investment, any return. Second year end we got 22,290. Third year end, this one plus third year return both will be summed up, so we will be getting 1,06,902. Then fourth year again add 46 with this, so I get 1,53,270 up to 4 year. Up to 5 year I have received 1,93,254 rupees amount. Here my investment being 1,35,000, I get that 1,35,000 between these 2 years. Okay, means 3 to 4. Between 3 to 4 years I am getting the money back. So I have to find out the discounted payback period for project A. So by the end of 3 I have a shortage, so I have to add from the 3 the base small year, okay, lesser year 3. How much shortage is there? 28,098 is the shortage amount, but in the next year I got this much amount, 46,368. Then what is the ultimate value? 3.61 years. Similarly, for the project B, you have to find out the cumulative discounted cash inflow. The cumulative discounted cash inflow in this case being 51,720. You now add the second year value with this, so you get 62,412, and then third year 60. So 62 is added. So after addition, the value being 1,14,132. Then next I am adding this value to get 1,75,668 up to the 3 years. Up to the fourth year value is also added. So I'll get 2,31,972. Finally, up to fifth year, I got around 2,74,812. For this project, I have invested 2,40,000 rupees. That 2,40,000 should be here. Okay, anywhere between 4 and 5. So between these two, the lower year being 4, at the end of fourth year, we have a shortage. Shortage being how much? 8,028 is the shortage. 8,028 being the shortage amount that can be achieved in the next year's cash inflow, discounted cash inflow. The next year's discounted cash inflow being 42,840. I got this amount over 1 year period, but I need only 8,000. Maybe a fraction of year is more than enough, probably 0.19. So 4 plus 0.19, 4.19 years. Between among this model also means a discounted payback period, shorter is the better, so A. For all the three models, NPV, PA, and discounted payback period, we are sure that A is the better project than the B. So we have to choose A, not the B. Clear? Question number 4. You are required to calculate IRR of the proposal. Okay. The company proposes to install a machine involving capital cost of rupees 3,60,000. Okay. The life of the machine being 5 years. So, in the very first year, there is an outflow of 30,000 rupees, 360,000 rupees. 5 years end, it has no salvage value. The machine will produce the net operating income after depreciation 68,000 rupees. So, net profit before tax. Okay, profit before tax being 68,000. For the IRR calculation, we are in need of what? Only the cash flows. So here we have been given net operating income after depreciation. So then it's your duty to find out what? Cash inflow. The company's tax rate being 45% and net present value for 5 years. For 5 years means annuity factor. Cumulative factor given is here. 14%, 15%, 16, 17, 18. For these 5 different percentage, the cumulative factor or annuity factor is given. So you have to find out the IRR. For the calculation of IRR, you have to multiply the CAF, cash inflow, with the annuity factor, and it should match with the cash outflow. It should match with the cash outflow. So the annuity factor you use for calculating this way, by satisfying this equation, the discounted cash inflow should equal to the cash outflow. That rate will be called as IRR. So we have to get it as a missing data. We have been given the cash outflow, which is 360, but cash inflow is missing. Now our duty is to calculate the cash inflow. From the profit before tax, you first to subtract the tax. Here the tax rate is 45%. So calculate 45% tax on this. 30,600 rupees. So after that, you get 38,600 rupees. 38,600 rupees. Is that clear? Okay. 37,400. This is called profit after tax. But I'm in need of cash inflow. What are the expenses or income recorded in the P&L account having no cash flow? You have to identify that and you have to reverse that. Here we have depreciated already 68,000 rupees is the profit after depreciation. 3,60,000 rupees is the initial investment we made at the 0th period. So we can calculate the depreciation per year. Original value minus scrap value divided by life. Original value being 3 lakh 60, it has no scrap value by the end of zeroth period, nth period. The life being 5 years, so naturally the depreciation per year here being 72,000. This 72,000 rupees might have been debited in the trading and P&L account, especially P&L account. Because of that reason, profit might have decreased. Though the profit decreased, this will not have any cash outflow implication. So, to find out the cash inflow, you have to add this back to get the cash inflow. So, add depreciation here. The depreciation in this case being 72,000 rupees. If I add, then I will get the cash inflow here. 1,09,400 will be the cash inflow here. Clear? We got the cash inflow. Now, 360 invested and you are getting 109.4 every year for all the 5 years. All the 5 years. Now it's your duty to find out the annuity means IRR. You know this formula. Cash inflow every year being 1,09,400 multiplied with the annuity factor by using the IRR should be equal to the cash outflow. The cash outflow being 3,60,000. So now the beautiful illustration here. We no need to calculate the annuity factor and the rate of interest using the missing data. Like you can find out the annuity factor from here directly. Annuity factor here is equal to 3,60,000 divided by 1,09,400. Then our required annuity factor in this case being 3.29. Now find out the 3.29 here. The 3.29 is falling anywhere between these two numbers, 16 and 17. Okay, so now let's see by using the interpolation. So by 16 percentage, my annuity factor being 3.27, making the rate of interest changed to 17 percentage. The annuity factor becomes 3. I need 3.29. Okay, so the required answer should be anywhere between 15 and 16. Okay, so for 15 percentage, we have 13.35. For 16 percentage, this value being 3. Okay. 3.35, and for 16 percentage 3.27. By making 1% change, the change in annuity factor here being 0.08, but my requirement being 3.29 should be the annuity factor. So from this I have to reduce only 0.06. For 1%, the change in annuity factor being 0.08, but I want only 0.06 change. What is the required value? So we start with a basic small number. With that, you just add the value arrive here, which is nothing but 0.06 divided by 0.08 into 1. So the answer being 15.75 will be the final answer. Clear? This is another way where we can get the annuity factor easily. Okay. Okay. Drawback of IRR. So if we have the conflict between IRR and NPV, you have to depend on NPV only. IRR will be the second choice. As per the NPV, A seems to be better. As per the IRR, project B seems to be better. If you apply the investment appraisal technique, by using the NPV method, you find that A project is better. By applying IRR, you get B project seems to be better. Now you get the confusions. Between these two, which is going to be chosen? Always you choose the result of NPV, not the result of IRR. IRR may be the additional support only. We never depend on IRR. Because IRR has some drawbacks. Some cases this IRR will not give us clear message. That's why we always depend on NPV or PI. The IRR will be the least choice. But if I am planning to calculate the best projects only based on IRR, no problem. But if I have two appraisal techniques, NPV as well as IRR, the first priority goes to NPV's suggestion, not the IRR suggestion. What drawbacks we have? If the cash flow seems to be not conventional model, what's that conventional? Initially you invest, every year end you are getting the cash inflow. So one time investment year after year, if you are getting, then that case IRR will give good answer. Some cases, if those method is not applicable, those cash flow model is not there, that is called non-conventional cash, then we will have a trouble. In this illustration, 0th period you invested 160 outflow. In the second year also there is outflow, but first year you have inflow. Then there is a trouble. Non-conventional. So conventional means at 0th period investment, thereafter regularly you are getting the money. But in this case, 0th period and second period there are outflows, and in year 1 you get inflow. Right. If that one happens here, we will get lots of confusions. So 160 outflow, 1000 outflow, and 1000 inflow. So you know that summation of discounted cash inflow should be equivalent to cash outflow. Cash outflow, that will be the IRR rate. If we have these 2 or 3 outflows rather than one outflow, okay, or a stream of cash inflow where we miss some streams also, only one cash inflow, 2 outflows are there, or 3 inflows and 2 outflows may be also be possible. For example, if you want to get the government's license for operating something, for mining, you pay 160 crores in the very beginning to get the license. Thereafter, using the license, you can extract all the minerals available in the land, but there will be a commitment. At the end of the project, you have to reset the place. Because of mining operation, the entire land may be collapsed. So, we have given you the rights to extract the minerals, but not to spoil the land. So, by the end of the life, you have to reset this. So, automatically what happens, there may be cash outflow involves the 0th period for purchasing the license, the nth period, there will be again outflow for resetting that site restoration costs. All these things will be there, right? In this case, we may have 2 IRRs. There should be only one answer, right? What is the rate of interest? 5%, 6%, okay. It may be either 5% or 6%, then there's a confusion. In this case also, you have lots of confusion because we have 2 IRR rates here. One is 25%, another one is 400%. Sir, do I want to get memorized? That's a no, not required to memorize. But when you are asked a theoretical question like, what are the troubles by facing IRR, or what are the troubles we have if I choose IRR method of capital budgeting, right? So for this will be helpful. So for 25%, year 0, year 1, year 2. Now, cash flows. 0th period 160 outflow. First year you have 1000 inflow. Second year you have 1000 outflow. Now 25% PV factor. Come on, tell me. For the year 0, it's always 1. 1 is equal to 1 at 0th period, right? So only for the first year in, the PV factor may be 0.8. 0.8. Next is 0.64. Am I right? Now find out the discounted cash flow. 160 into 1, 160 minus 1000 into 8.8, 800 rupees. 1000 into 0.64, 640 negative. 2 negative, 1 positive ends with 0. So 25 will be the IRR here. 25 will be the IRR. Now what happens in case of 400 percentage, sir? Okay, PV factor at the rate of 400 percentage. So 1 divided by 5, 0.2 I think, am I right? And here 0.2, 0.02, right? First one is 0.02. 1 divided by 5, 0.2, then 0.04, 0.04, okay. 1 divided by 1 plus I. 1 divided by 1 plus I in this case being 400 percentage means 4. Okay. Always you will face the trouble. 1 divided by 5 will be the value here. Now discounted cash inflow. Discounted cash flows. 1 into 160, 160 negative, and 1000 into 0.2, 200 positive, 1000 into 0.4, 40 negative. Again it ends with 0. It means outflow is matching with the inflow. So outflow inflows are matching at the rate of 25 percentage as well as at 400 percentage. If you ask about what is the project's IRR, if I tell you either it may be 25 percentage or 400 percentage, it's a misleading, right? There should be only one answer. There should be only one answer. 400 percentage means this gives you exorbitant profit, but naturally it may not be so. It may be either 25% or 400% actually misleading. So we never depend on IRR. IRR suggestion may be taken as a secondary only. Only NPV suggestions is even most important here. Clear? This question may not be asked the examination, but for the theory, you can give this answer also. And similarly, one more case. See here. In this case also the same problem comes. Project A, in usual conventional cash flow means we need to have outflow at the 0th period and inflow in the 8th period. But in project B, inflow in the very beginning, outflow in the next period. And for this, the IRR rate being 50%. For this, the IRR rate being this one, 75%. Okay, IRR. So for the project A, IRR rate being 50%, for project B, IRR rate being 75%. Clear? As per the IRR's decision criteria, the project using more IRR is chosen. So definitely you see that B seems to be the better one, so you choose B. Naturally, what happens, by just like a colloquial approach or means practical approach, you received 4,000 rupees, for that you have to repay 7,000 rupees. Repayment is higher. You have to repay with 75% interest like. And here you paid 4,000 rupees earlier, but you are getting 6,000. Means 50% being the return. This seems to be return like, this seems to be cost like. But IRR says, if the IRR is higher, you choose that. As per the blunt IRR answer, you choose B. But in a real sense, you get 4,000 rupees, for that you have to pay 7,000 later, means cost like. Here you spend 4,000 rupees, later on for that 4,000 you are getting 6,000, means revenue like. Definitely A is superior. A is superior than the B. Anyhow you will get misjudged because of the IRR selection criteria. So as per IRR, project B is better, but originally which is better? A is better. So in this case also, this is being the non-conventional cash flows, will get misguided. Here also we get misguided. So when we have multiple cash outflows over the tenure, you will have multiple IRR trouble one. Next one is cost and revenue mismatch. Initially there should be outflow, thereafter inflow. Only then IRR will be suitable, else will get confused. Now, in order to avoid that trouble, what we have? So we have modified IRR. Let me finish up modified IRR first, then I'll brief modified NPV later. Okay, modified IRR. So this modified rate of IRR is applicable when there is a conflict in IRR and IRR drawback is simply removed. Okay, drawbacks are removed under modified IRR. In case of modified IRR, whatever the outflow you invest now and then, it's not single time investment, multiple time. Only single time investment, no problem. Traditional one is okay. If we have multiple investments or a stream of period, okay, then we have to depend on modified IRR. All the investments are discounted based on the present value factor, means the cost of overall capital to the 0th period. But inflows, that will be taken to the nth period using the future value factor, reinvestment like. That's the logic. For example, in this illustration, let me explain the logic here. Okay, here we have 6 years. 0, 1, 2, 3, 4, 5, 6 years. 0th period we have outflow. First year we have outflow. Second year we have inflow. Third year inflow. Fourth year inflow. Fifth year inflow. Sixth year inflow. Outflows are brought to 0th period. 0th period using PV factor. Inflows are taken to the nth period value, 6th year, using future value factor. 100 rupees if you have in your hand today, together with the 10 rupees, it becomes 110 in the later period. This 110 is called future value. This 100 is called present value. You understand? To get the present value of this number, usually you divide this 1 by 1 divided by 1 plus I. This is the formula you use. For future value finding, you have to multiply with the 1 plus I. That's all. To the power n. Okay, to the power. For present value, 1 divided by 1 plus I to the power n. For the future value, into 1 plus I. That's all. Into 1 plus I to the power n. All the cash outflows are brought to the 0th period. All the cash inflows are taken to the nth period. How can you take to the nth period? Whatever the return you get, you deposit somewhere, that deposit will fetch income. So, together with income, how much it should be in the nth period will be arrived. Now, for calculating the PV factor, present value factor, you have to follow KO rate. To arrive the future value factor, you have to follow return on investment. Okay. So for the outflow, you are borrowing and investing. So borrowing rate will be taken. Whatever the income you generate, you can invest in some banks or somewhere, you'll get return. So for the cash inflow, you need to use the returning rate. For the outflow, you have to use the cost. So two rates are there for the MIRR. One is cost, another one is investment return on investment, right? So you have been given two rates. This is all about cost of overall capital is applicable for what? These two, for bringing to the present value. And reinvestment rate, this 15% is applicable for what? Inflow. For that, you are going to calculate the future value. Okay, clear? Let's see. Now I will calculate the cash outflow at 0th period. Cash outflow. Year 0, 1. Cash outflow for this year 100 and here 77.85. And 12% PV factor. What about the 12% PV factor is all about? It's KO PV factor. 12% PV factor for the 0th period, this one only. 1 rupee is equal to 1 rupee only now at the 0th period. If I am talking, if I have 100 rupees, how much I have at that time of 0th period? 100 only. If I deposit 100, immediately go and check how much I have in the bank. 100, he says. If the days are passing, then interest may be accruing. So 0th period, the value being 1. For the first year, 12% PE factor will be used towards the value. 0.893. I can round off this. Now you multiply these two, then I'll get discounted cash outflow 100, in this case being 69.52, overall value being 169.52. This is the outflow. We got the outflow. Now I'm going to calculate the inflow case, cash inflow case. Year, we start with year 2, 3, 4, 5, 6. Now, what about the future value factors are here at the rate of investment? Future value investment is nothing but 1 plus I to the power n. Here, 1 point I being 15%, 1.5 to the power n means 2 years. This is 3 years. This is 4 years. This is 5 years. Is that clear? So you can use the calculator. Okay. So 1 divided 1.15 in your non-scientific calculator, you just press equal, you will get the value directly. I need to make slight correction here. Wait, please. This will be here. Okay, once again, listen. Cash inflow. Second year 20, third year 60, then 80, 100, 120. For this future value factor, and then future cash inflow. For the last value, that value remains same. Okay, that value remains same. For this 1 year interest will be addable. How many years? 1 year interest. So 1.15. Because 5th year investment, how much it should be by the end of 6th year means it carries only 1 year interest. So 150. And in this case, 4th year, for that how many years interest will be there? 2 years. So here power 2, here power 3 like. So 1.15 to the power 2, the answer being, come on, 1.323. Okay. This will be 1.15, 1.15 to the power 2, 1.15 to the power 3, 1.15 to the power 4. Okay. 3 means this value should be 1.521, here 1.749. You multiply these two, 20 into 1.749, this value being 34.98. Next one being 91.26, and next one being 105.84. Overall total being 467.08. 467.08. So the outflow in this case being 169.52, inflow being 467.08. Inflow by the end of 6th year, outflow at the 0th period. Now you have to find out the IRR. Two extra steps thereafter. IRR calculation is the usual way. First step is all about finding current value of the outflows using the cost of overall capital. In case of inflows, you find out the future value of all the inflows using the return on investment rate. So we found out both. Now you have to find out an IRR rate, a discounted IRR rate, so that the discounted cash inflow should be equal to the cash outflow. You have to find out the missing data as in trial and error method. Let's see. I'll start with 18 and 19 percentage. 18 and 19 percentage. Okay. At the 0th period, you have 169.52. This becomes 467.08. Now, what about the rate of interest? This rate of interest is the IRR. I assume two rates, either it may be 18% or 19%. Okay, assumption. So how can I assume in my exam, sir? No need to worry about that. Number may be given, a rough number, 4 or 5 numbers may be given. So within 4 or 5 numbers, that IRR could be. So as per the MIRR rate, okay, cash inflow multiplied with the PV factor should be equal to cash outflow. This will be considered as cash outflow. This will be considered as cash inflow. Then you can use the other way here. Cash inflow in this case being 467.08 PV factor. Can I take at 18%? So I assume 18%. What is the 18% PV factor here? How much? 18% PV factor. Zero 0.370. 0.370. Cash outflow being 169.52. Okay. 4 digit. I will have 4 digits. The final value in this case being 3.486. Now I can make it 19%. 467.08 into what is the P factor at the rate of 19%? 1 divided by 1.19 for the 6th year. Year 1, year 2, 3, 4, 5, 6. I think 0.352. 0.3521 minus 169.52. Okay, so 467.08 into 0.3521 minus 169.52. So then this value being minus 5.061. So at the rate of 18% you have the positive value. At the rate of 19% you have negative value. Definitely our required answer should be anywhere between these two numbers only. Is that clear? So what we have to do? We have to first to finish up 2 steps. Step number 1 is all about calculate all the cash outflows to the present value using the P factor at the rate of company's cost KO. And all the inflows are taken to the future value using the reinvestment rate. You now get the future value cash inflow, present value cash outflow. Now you have to find out the missing rate. At what rate this present value becomes future value. So that rate could be arrived or found out using the trial and error method. So we found out it may be anywhere between 18 and 19. So I'm going to finish up that now here using the interpolation technique. Let's see. At 18%, we have, what is this value? Or you can use this value also, 3.486. At 19%, this value being minus 5.061. The difference being 1% makes the difference of 8 point, how much? 8.547. 547. But I have to make it 0. NP means these two should be equal, no? Okay, these two equal. Then if you subtract this one from here, then you will get 0. So you have to make it 0. Otherwise, you have to reduce 3.486. The other way of interpolation, rather than taking the total of this one, you can take the net value also, you will get the answer, right? Now I want to reduce only 3.486, not so much. Because of making 1% change, the reduction being 8.547. But I don't want that much change. I need to reduce only 3.486. Then what could be the percentage change from the lower number? Okay. So here the value being 18 percentage plus 3.486 divided by 8.547 into 1. Then what's the ultimate value? 18.40 percentage. Clear? In book we have 18.43, like you can go with that one also, no problem here. Clear? Come on, text me. Now in text, how did I solve this? This one is found out. Then cash outflow divided by cash inflow is equal to the PV factor. Cash outflow being 467.08. Okay. Cash inflow being, oh, cash outflow is how much? Sorry. Cash outflow being 169.52 divided by cash inflow being 467.08. You can find out the missing data like this one. The other way also you can solve this, right? I hope the required PV factor is 2.76. Okay, to find out 2.76 factor, what rate can be taken? 18 or 19, you can do it the other way. So earlier illustration we solved the same method, right? The question number 4 is similar to the method we have solved in this illustration also. You can solve in either way, no issues. Clear? Now MNPV, modified net present value. Again take these two values. That's all. Again take these two values and find out the NPV as usual. How do you calculate the NPV? NPV is calculated. How? NPV is equal to summation of discounted cash inflow minus cash outflow is the NPV. Otherwise, cash inflow into PV factor or annuity factor minus cash outflow. Is that okay? In case of modified NPV, you are going to use the same. The cash inflow of the nth period will be taken. Okay, cash inflow of the nth period or future cash inflow into PV factor minus cash outflow. The same. The future cash inflow in this case being 467.08, PV factor at the rate of 12% for the sixth year. Come on, get me the PV factor for the sixth year. 0.506. Cash outflow in this case being 169.52. Then get me the ultimate value. 67.12 is the final answer in PV. So whatever the value you are at for the 0th period as well as future value, the future value is going to be now discounted using the cost of overall capital, KO. KO is different and R is different. Return on investment is used only when you are taking the cash inflows to the future value. Otherwise, we follow only the cost of overall capital. Is that clear? So rest of the same. Whatever the cash you get in the future, what is the present value of that? You find out that using the cost of overall capital. From there, you subtract the cash outflow to find out the NPV. In this case, it is modified NPV. In this case, it is modified NPV. Clear? This illustration, one of the most interesting illustration asked in CA final very long back. We have been given some missing data and our duty is to find out the missing data. Following are the data on capital project being evaluated by the management of X Limited. Annual cost of saving, useful life, IRR, PA. These four details were available. So usually what we do, from the available information, you find out the IRR and PA, but here IRR and PA were given. And you are supposed to calculate NPV, cost of the capital, cost of the project and payback period. So these are the four items to be calculated and salvage value of this project being 0. Yeah, of course, for this you have to use the PE factor and annuity factor. For the PE factor and annuity factor, here table is given. The table gives us the annuity factor and PE factor. These are the PE factor, this one is the annuity factor. The combined value of this one will be the annuity factor. These are given. We have been given only 4 values. So use the only 4 values. Whatever it may be, IRR, whatever it may be, we have only the 4 values to be calculated. So you no need to worry about the trial and error method also, because within this you can finish up all. Right. Now, let's start. We have been given the profitability index as well as IRR. What is the formula for IRR? IRR is equal to cash inflow into annuity factor with this rate should be equal to cash outflow. That you know. Cash inflow, rather than the inflow, here there is a savings is considered as inflow 40,000 rupees. And annuity factor for 15%, 2.855. So from this it is very easy to find out the cost of project cash outflow. What's the value? 1,14,200. So cost of the project being 1,14,200. Out of 4 we have calculated 1. Payback period is very simple, right? How do you calculate the payback period? Cost of project or cash outflow divided by cash inflow, provided if the cash inflow being equal. Yeah, of course, the cash inflow being 40, which is equal. 1,14,200 is the cost of project divided by 40,000 rupees. Then final value being 2.86 years. Less than 2 years, you will get your money back. So we got the answer for 2. Now, we have been given the profitability index. The formula for profitability index in this case is equal to summation of discounted cash inflow by cash outflow. Okay. Here, this one, summation of discounted cash inflow is nothing but cash inflow into annuity factor at the applicable cost of overall capital. At the applicable cost of overall capital. Now substitute the values here. PA being 1.064. This cash inflow being 40,000, which is the cost of savings. I need to find out the annuity factor, which is the missing data. Cash outflow in this case being 1,14,200. So annuity factor in this case is equal to 1,14,200 into 1.064 divided by 40,000. Come on, get me the value. Yeah, make it faster. 3.037 or 38. So the requisite anti-factor in this case being 3.038 false here. It means company's cost of capital should be 12%. This anti-factor is calculated at the rate of 12% for 4 years. So we have to find out the anti-factor at which the cash inflow is discounted to get this value. this value. So here 12% for 4 years. So then this 12% is considered as cost of overall capital. Okay. Finally, NPV. NPV is equal to cash inflow into annuity factor minus cash outflow. The annuity factor is calculated at the rate of company's cost of capital for the life, okay, in years. So cash inflow in this case being 40,000 rupees, annuity factor for this value 3.038, 3.038 minus cash outflow in this case being 1,14,200. What's the final value? 7,003. 7,320 will be the NPV. See, before we go for the ninth illustration, we try to understand the various terms. What is called EBIT, EBITDA, earnings before interest and tax. EBITDA, earnings before interest and tax, depreciation and amortization, cash inflow before tax, cash inflow after tax. So you have to understand all these terms here. Right. Now, capex. From the sales, what the format I have given here, I am going to follow that simply. That's all. Right. If you make a sales of rupees 1,000, you may incur some expenses. Okay, cash expenses. Cash expenses does not include a cash expense does not include what? Non-cash items like depreciation and amortization. We spend around 600 rupees. After subtracting the cash expenses from the sales, the value what you get here is called cash inflow before tax. Cash inflow before tax. Otherwise, this will be named as EBITDA. Okay. Earnings before interest, tax, depreciation, and amortization. So we have not subtracted the depreciation here. See the question clearly and read. Whether it is cash inflow after tax, or cash inflow before tax, or profit after tax, or profit before tax, or cash profit, what term is given, go and read it properly, and from there you try to arrive the cash inflow. So if the cash inflow before tax is given, from here you have to do these operations to find out the cash inflow after tax. You have the multiple steps. Right. Now, from there you can now subtract the non-cash item, means depreciation and amortizations are going to be subtracted. Maybe the depreciation for the period being 100, I subtract that. After subtracting this, the value what I get here is called EBIT, earnings before interest and tax. Otherwise, it may be named as PBIT. Okay, profit before interest and tax. Where we have the E can be replaced with P also. EBITDA, PBITA, right? Whatever it may be. So both are the same. Predominantly, we call this being the EBITDA and EBIT. In some others, they may prefer using the PBIT also, or communicates the same message. From there, we have to subtract the tax. If the tax rate applicable for this company being 30%, tax on this EBIT being 90. Okay, 30% on 390. The value what you get here, 210, is named as earnings before tax. Oh, I missed to subtract the interest. Sorry. Okay. So what happened? So here it is assumed that we don't have interest like. Okay. So this is called earnings after tax. This is called earnings after tax. So we assume no interest situation. If we have interest, then we can subtract the interest also from the EBIT. Usually we assume we don't have the interest, because for the interest only we are going to use the factor, okay, present value factor. So the value what we arrive is the EAT. EAT or PAT, profit after tax or earnings after tax, can be used only for the ARR calculations, accounting rate of return or average rate of return. For this, so you can use it. For rest of the capital appraisals technique, we have to use the cash flow only. For arriving the cash flow, so you have to add the depreciation and amortization back. Depreciation and amortization back. So this 100 rupees will be added back to get 310. This 310 is the cash inflow. Simply we can call this being the cash inflow, or in detail cash inflow after tax. See, this is cash inflow before tax, this is cash inflow after tax. In the question nothing stated, just they have given cash inflow. It means always this is representing only cash inflow after tax, cash inflow after tax. Okay, so here total cost excluding non-cash items. The non-cash items are the depreciation and amortization, and earnings before interest and tax, it's okay. And you have to add the non-cash items back, which is nothing but depreciation and amortization. Okay. Sometimes rare, you have to do some plus or minus for capex. So here depreciation and amortizations are added. Sometimes there may be income, may be credited in the P&L account, but cash is missing. 1 lakh rupees worth asset, today's value being 80, 20 is depreciated, so you debit it. Because of the debiting of this depreciation in the P&L account, actually cash has not gone out. Okay. In a reverse case, the 1 lakh asset, today's valuation, we have done a revaluation, found that it's worth 1 lakh 20, appreciation. Depreciation debited in the P&L account, similarly appreciation of the assets credited in the P&L account, but we don't get any cash. In the balance sheet, 1 lakh rupees assets is now rewritten as 1 lakh 20. Because of that reason, we don't have any cash transaction. In case of depreciation, first you subtracted, later you added. In case of appreciation, first you added, later you subtracted. That's a basic logic you have to understand. The final point you have to understand is all about capex, capital expenditure. You may purchase some capital investment assets. For that, there may be cash outflow, and sometimes some of the assets used for your means your operational purpose, like an asset, later on you don't want, so you are discarding the assets, realization value of the assets. So if you are discarding some of the assets, then capital amount is released, capital expenditure negative. You are purchasing new asset, money goes out for the capital investment, so capex, that will be called as capex. In case of capex, money goes out, so subtract. In case of capex sold, capex revenue, okay, that will be added back to find out the cash inflow. In simple sense, cash inflow represents only cash inflow after tax only. So you no need to see whether it is cash inflow after tax or before tax. If it is only cash inflow, no need to worry about that. That's cash inflow after tax only. Clear? So the non-cash items I have given here is nothing but depreciation and appreciation. All these things will come. EBITDA means earnings before interest, tax, depreciation and amortization. That is cash inflow before tax. So this is the format. In simple sense, cash flow is equal to PAT plus depreciation minus capex. Okay. So if PAT is given in exam, you have to do depreciation plus and capex plus or minus to get the cash inflow directly. So whatever the term given, from there your end result is this one. You have to find out this only can be used for the capital appraisal technique, except ARR. Clear? Yes, note it down, this format. Shall I move on to the next one? If it is clear, I will move on to the next one. How can we calculate the cash flows? Okay. In case of purchase of assets or investing in assets or investing in working capital, Right. So you have to understand these two first of all. Now what happens? Period 0, 1, 2, n years. You purchased an asset for rupees 100. After some years of usage, this value becomes 20 or 30. This is original value. This is scrap value. This is your outflow. This is inflow. So this 20 will be merged with the inflow. This will be merged with the outflow. In case of investing the money for working capital comprises of what? Debtors, cash balance, stock and all, without which you cannot start and run the business. If buyer comes to your place, you have to show him some material. So you have to keep around 1 lakh rupees material stock, and you need to have around 50,000 rupees worth of cash. You need to sell the goods without getting any cash. Sir, take this goods, sir. You can pay it later. For that, you get your money locked up to 1 lakh. So you are in need of 2.5 lakhs. So usually this working capital may be invested at the zeroth period, or at the zeroth period it may be 2 lakhs. Because debtors we usually don't have. 1 year later only we have the debtors. Once you start the business, you start with the stock. Sometimes later you are selling and there may be pending amount, then it becomes debtor. So working capital may be static at the beginning, or sometimes later second year end or third year end it may be invested or further invested. Like, remember, whether it is stated or not, nth period, you assume that entire value is recovered when in the nth period. At the zeroth period or first year end or second year end, as per the question, the working capital could have been invested. If nothing stated with respect to the final value, always assume the entire value is recovered in the nth period. Why? You have the stock. Once you close the business, stock is not required. Sell off and get the cash. So in case of asset, we start investing with original value. In the nth period, you have the scrap value. But in case of working capital, you invest as and when it is needed. Always that working capital will be released in the nth period. So these are the 2 points you have to understand. Clear? So initial investment is outflow, scrap is the inflow. In case of working capital, initial investment for the working capital is outflow, releasing that investment at the end, default. Whether it is stated in the question or not, always assume. Now, the last point I'm going to discuss is very important: tax sheet. Tax sheet. Okay. Tax sheet. Wherever there is a spending, to the extent of tax will be a savings. Wherever there is an income, to the extent of tax will be subtracted. Net will be only after subtracting the tax. Clear? For example, in your P&L account, you have GP 1000, you have cash expenses, 500, non-cash expenses 200. Then what happens? 300 being profit before tax. If the tax rate being 30 percentage, okay, from profit before tax, you subtract the tax 90, 30 percentage on 300. You end up with profit after tax being 210. Is that clear? Every income is reduced due to the tax payment. If you have 1000 rupees income, you have to pay 30% tax on that, right? So 30% tax has gone. Net of that income should be only 700. Only 700. Every cash income, there will be tax payment. Subtract that, balance will be your gain. Similarly, in case of every expenses, to the extent of tax you are saving. So 500, no. By debiting this 500 in your P&L account, your profit goes down. To the government you are stating that, sir, I paid the tax, so my profit gone down. My profit gone down, so I'll pay lesser tax. Whenever you debit any expenses, your profit will go down, you pay lesser tax, it means there's a tax savings. So the tax savings will be 30% and 500, 150 saved, actual expenses being 350. Actual expenses being 350. Every 1 rupee penny you receive actually comes to your pocket only after tax. 1 minus T. 1 minus T. How do I get? Cash income into 1 minus T is the net. Similarly, cash expenses 1 minus T. Net of tax is your ultimate expenses for every 100 rupees. See, whenever I go for spending in restaurants, hotels, star class restaurants, the lunch cost is 1,500, 2,000 rupees, like huge. 1,000 rupees seems to be exorbitant spending, like. But business people are lavishly spending. If the restaurant announces you 30% discount, will you be happy or not? Okay, you will be happy. You want to have 1 day's food in the morning itself? Huh? Sir, give me all the 3 course meals now itself. I'll finish off 3 because 30% discount in the morning. For the business people, whatever the spending they do, that spending debited to the P&L account, profit will go down. For the reduced profit, they will pay the tax. So they say, sir, 500 rupees is the spending, sir. Government says 500 spending, reduce your profit by 500. So now you show only lesser profit. To the extent of reduced profit, you no need to pay the tax. That 500 rupees into 30%, 150 you no need to pay. It means actually you are paying only 350. That's why the business people can spend more. Directly they have the savings to the extent of tax. Similarly, whatever the income is there now, to the extent tax will go off, balance only they will receive. This will happen for all. If you are being the salaried person, whenever you receive the salary, you have to pay the tax and rest will be your spending amount. So for the business people, whenever they get any money, less the tax, balance will be their pocket. Both are same. See, very interesting concept. Business as well as personal. Business as well as personal. What about your scenario? Income. You get 1,000 rupees if you are running the business. Okay. If you are not having the business, being the employee, you will get 1,000 rupees. If you are running the business and getting 1,000 means it's a business income. If you are being the employee and getting money, salary income. Name is different. Anyhow, this is the income. And applicable tax rate being 30%. So out of the business income, 30% tax is paid. So left with only 700. As you are being the employee, what happens? You have to pay what? Tax. Same 30% if you are paying, then left with only 700 rupees for your spending. Now from there you have to subtract the spending. You have to subtract the spending. Okay, what are the spending you do? Food, dress, shelter. For this, roughly you are spending around 500 rupees. You are spending around 500 rupees. After spending, how much you have in your hand for your future requirement or surplus to be saved? Surplus saved or negative, whatever it may be. This is what about your ultimate remaining value to be saved. Isn't it? But in case of business people, 500 rupees spending, they can subtract the tax to that extent of the spending. 30%, 150 can be saved. Only 350 is their expenses. From 700, 350 is subtracted, so they will save 350. Very first instance same, but remaining extent what you have, business people will have more money than employee. Why? Because you collect the money, pay tax, whatever the amount left over can be used for your food, dress and shelter. What happens for the business people? Collect the money, spend for food, dress and shelter, whatever the amount left with him finally can be used for tax payment. Let's see. He will say, business person says, in his P&L account, his income, gross profit, 1,000. Food, dress, and shelter 500 goes, and he says, I'll get 500 rupees being the profit after tax, before tax. From the profit before tax, he subtracts the tax at the rate of 30%, 150. Net profit or profit after tax taken to the balance sheet is 350. This is all about business people. But for the personal requirement, what happens? Your income, individual income, who is being the employee, he gets a salary, 1,000 rupees. Food, dress, shelter, he spends 500 rupees. Is that okay? Provided the tax payable is only on this. So, salary 1,000 minus tax 300, 700, food, dress, shelter 500. So, 200 is the savings. But for the business people, PGBP, profits are gains from business or professions 1,000 minus food, dress, shelter 500. 500 being the profit before tax, and he has to pay the tax on this 500, 150. Left with him balance being 350. See the difference? But he will say not food. It may be tiffin allowance or tiffin something, dress, uniform, shelter, quarters. The name is changed. Then once the name is changed, this becomes his business expenses, like clear. So always the business people will enjoy more because this reason. Okay, because this reason. Okay, always find out the difference between the salaried person's savings as well as business person's savings. The savings is equal to the tax savings on the cash expenses. Cash expenses 500 rupees, tax savings on that 500, 150. That will be the difference. Here, here. This is cash expenses. Actually, business person says, though it may be 500 rupees, to the extent of tax on that 500 is saved. Net cash expenses being only 350. Whenever there is an income, net of tax, his income is income into 1 minus T is his income. But in case of depreciation, non-cash item, cash has not gone out, but you are debiting this 200 in your P&L account. Cash has not gone out, and you have debited. But debiting reduces your profit. If profit reduces, you no need to pay the tax. Or tax on that reduced profit saved. So automatically what happens? This becomes here. To the extent of T will be the savings here. 60 rupees comes here. You understand? In case of cash expenses, 1 minus T is the net cash expenses. In case of non-cash expenses, to the extent of T becomes your income. Cash has not gone out, but income reduced. To the extent of reduced income, you save the tax, you don't pay the tax. It comes this side. Now you tally this. 760, 760. What is the ultimate value? Profit after tax. Hmm? The value what you get here is 410. This 410 is nothing but cash flow. Here you got PAT 210, right? To get the cash inflow, what do you have to do? PAT plus non-cash item depreciation. So PAT is 210, depreciation is 200. If you add, then you get 410. You get the 410 here directly. So how do I calculate here? It's very simple. In case of cash expenses, okay, this is before tax. You have to find out the expenses after tax. How do I get? You have to multiply with 1 minus t. Similarly, cash income, you have to pay the tax. So your cash income after tax will be after 1 minus t. Okay, after 1 minus t. Okay, now, cash income, non-cash expenses, non-cash expenses. In case of non-cash expenses like depreciation and taxation, to the extent of t is your income. Cash income, net of taxes after multiplication of 1 minus t with that. In case of non-cash expenses, it reduces the profit, but cash has not gone. So, though it reduces the profit, ultimately it reduces the tax payment also. To the extent of reduction of tax payment is your savings, that will also be income. If there is non-cash income, actually you don't get any cash. But income is inflated due to this one. You have to pay more tax. So, in case of non-cash income, to the extent of t is my expenses. This is expenses, this is income. If you add up all these things, you will get cash inflow or cash flow. Is that clear? Okay, this is another shortcut. Rather than this way, you can work out this one also. If you have been given the cash flows, cash expenses, non-cash expenses, cash income, non-cash income and all, rather than working out this format, you can use this format to get the answers straight away. Okay, see here. I'll just give one more illustration here. Okay, in your P&L account, cash income 1000, appreciation being non-cash income 500, cash expenses 800, depreciation 200, 1500. Your profit before tax being 500. Profit before tax 500, applicable tax rate 30%, then tax being 150. So ends with PAT, profit after tax being 350. Now for our capital appraisal technique, we need only the cash flows. For arriving the cash flow, you have to start with PAT if PAT is given 350. Add what? Any non-cash expenses. Non-cash income should be subtracted. Depreciation is added and appreciation is subtracted. Now the ultimate value being 50 is the cash flow. Cash flow. Rather than working this way, you can use the other way. How? Income. Okay, non-cash income. In case of cash income, 1 minus t will be taken. In case of non-cash expenses, into t will be taken as your income. In case of expenses, cash expenses, 1 minus t will be taken. Non-cash income, on that into t will be your expenses. Find out all the items one after one. In the very first instant, cash income 1000 into 1 minus t, 1 minus 0.3, 30%, 0.3. Okay. Now 1000 into 0.3, 700 rupees will be the value. And next one here, non-cash expenses. Which is the non-cash expenses? I have taken this one. This one being the non-cash expenses, 200 to the extent of t being 0.3, which is 60. So 760 is your income. What about the cash expenses? 800 being the cash expenses. In case of cash expenses, into 1 minus t will be the post-tax expenses. So tax rate being 30%, 0.3. 800 into 0.7, 1 minus 0.3, 0.7, 7 into 800, 560. In case of non-cash income is all about appreciation 500. Further to the extent of T being 0.3, 150 will be considered as your income. The overall value in this case be 710. So your cash flow in this case be 760 minus 710, 50. You'll get both the same answer here. So you have to understand the logic. Okay, from the PAT you can add the depreciation and subtract the appreciation back. Yes, each and every item can be taken. Check whether it is a cash expense or non-cash expenses. In case of cash expenses before tax, cash expenses after tax should be into 1 minus T. In case of non-cash income to the extent of T becomes expenses. Non-cash expenses to the extent of T becomes income. Okay, I have given the summary here in detail. Tax shield impact. In case of cash income, 1 minus T will be applied. In case of non-cash income into T becomes outflow of cash like, and in case of cash expenses, 1 minus T will be applicable. In case of non-cash expenses, it becomes income like. You understand? These are the 4 items. Come on, make a note of it.